Hello, everyone. This is Matthew Bell. I'm the Executive Director of SC Launch Incorporated with South Carolina Research Authority with SCRA. And welcome to our webinar series. This is part 4. We're referring to it as the exit. And we've got two gentlemen here who have been through that process. I'd like to welcome Steve Clemons and Lanford to the presentation here and give us a little bit of background on their exit, the experiences they went through and how that go. And it's Lanford Holloway. I apologize, Lanford. I blanked for a second. But I got a series of questions for you guys, and I'd love to hear a little bit more about, how it occurred, what had occurred, and get your personal experiences on that. But also, I was hoping you could relate to people listening to the webinar as to, what were some of the lessons learned and what are some takeaways from your experience having been through that. So that's the objective for today. If I could, Steve, could I get you to just introduce yourself and your company?
Sure. Steve Clemons, company that I exited was VitaLink Research. When we exited, it sold to Velocity Clinical Research, but actually exited the company twice. Founded it in 2004, sold it to private equity in 2016, completely bought it back in 2020, and then sold it again later. So kind of wore various hats from the founder of doing everything from changing a light bulb, cleaning a toilet, to selling, and then professionalizing. And then when we bought it back was due to a failure to launch, which we can get into at some point in time, but then resold it. The goal was 3 years, but we resold it 18 months later to a strategic. So it can definitely relate to all the topics that you just shared, and I'm happy to do so later.
Perfect. Lanford?
Yeah. Thanks, Matt. I'm Lanford Holloway, and I was the former founder, I guess, and CEO of TerraStride Incorporated. We sold the company in November of last year to a private equity group out of Connecticut that owns a holding company for a lot of outdoor brands called GSM Incorporated. The company was founded, I guess, about 11 years ago, and it was a software company. And we had two different major lines of software. One was catered towards large tract property sales, and the other was catered towards hunting and property management. And that was by far our most successful piece of software. That one was downloaded approximately 6 million times, and we had a couple million active and engaged users that were part of that ecosystem.
Very good. So for both of you, you've already given a little bit of a description on your exits, but at a high level, I just want to kind of start with kind of the strategic view before we get into the minutia of how the process works. Is there anything, Steve, it sounds like you had a unique experience of a acquisition, and then you bought it back and then another acquisition. And I wondered if you could color that a little bit, because it's a really interesting situation you don't run into too often.
Yeah. So the first exit was your typical bargain basement boilerplate. Founders don't understand it, and by education, I'm a clinician, so I'm a dual board certified family nurse practitioner. So I don't have an MBA, and I actually got it through the School of Hard Knocks, which is a separate story. But long into the short is, it was your bargain basement, shop it out. We had 8 offers and 7 parties, and it was the circus, is what we call it, is when it comes to town and you have to put on a show for private equity or venture capital. We went through that round in 2016. We chose what we thought was going to be the best partner, and frankly, it just wasn't a great marriage. In 2020, we reacquired the asset back for pennies on the dollar, and then we used all the information we learned through the process. Again, we learned how to professionalize. We knew what to do, and we knew how to operate the business. So it was a perfect storm for the goal. And when I was elected the CEO at that point, to rebuild, to sell. So the goal was 3 years, obviously, to create long-standing drive for how we could grow it. When we did, we actually sold it in 16 months because of relationships we had in the industry, and it was a strategic sale. So very different. I actually did an outreach to that party. We had a very good relationship. We operated the businesses very similarly. There are differences. Everybody that builds a house is going to see it change colors when somebody else writes a check for it. But the holistic approach of how they operated was similar. So I thought it was a good fit. And frankly, it was time for somebody else to take the reins. So the strategic exit versus the private equity exit were two completely different things. And again, happy to share experiences from both.
Perfect. Lanford?
So for us, the path was a little bit different. We weren't really trying to sell, at least not at first, although there was a little bit of, well, that thought had been growing in my mind. I'll put it that way. We had investors on our cap table that had been there for about a decade, a little bit more. And to be clear and fair, nobody had ever said anything about, we want you to sell, we want our money back. That had never come up, but I was keenly aware that they hadn't, given us money through some sense of altruism, right? These people had an investment and they wanted to get a return at some point. And of course, there are options. You could do stock buybacks or dividends or a lot of things like that. But it became, obvious that a much clearer path was just, a sale of the company. Actually, there's a local company here in Columbia that had worked with a group out of San Francisco, of investment bankers, that is. And they had a very, very positive experience with them. And apparently, after the culmination of that sale, that group had asked them who else kind of in the Columbia, South Carolina area they should chat with. And I knew these guys, and they said you should chat with Lanford at TerraStride. And so we had dinner, and this was about 3 years ago. And I liked the guys in the group, and they came extremely highly recommended from my friends here in Columbia. And so we started kind of laying out a path saying, look, we're not exactly where we'd like to be in terms of total revenue. Our growth was very good, but there's kind of a threshold where you want to reach in terms of total revenue, so that you can really kind of gain the attention of the major players. And we weren't quite there yet. But thankfully we got there, I guess, about a year and a half ago or so, and then started the process in earnest. And of course I can chat more about the investment banking process later, but that was kind of the path to that, as it kind of made sense. And we started, discussing it. And like I said, while we didn't have any specific plans to sell, from a strategic standpoint, that felt like it was time. But again, we can chat about that more later too.
So our organization is one that works with very early stage companies. In some cases, just a founder and an idea. And in other cases, they're something more sophisticated. One of the mechanisms we use for coaching is to try to get, even at some of those early stages, the founders to start thinking about their exit so that they know what they're building towards. I'm kind of curious for you guys, is that a good piece of advice, bad piece of advice? Did you guys start thinking about it very early? How'd you approach that?
No. So I'll chime in first real quick. So no, when I was 28, whenever I founded with a team of people, and we had five people on this team that founded the original company, which had different iterations as it grew. I had no idea, concept, thought, or anything. I thought I'd give the company to my kids, which ironically, my kids just tell me that they think I'm on the phone all day. So they didn't want any part of it. So part of the challenge with us in 2016, when we sold through private equity, was we did have a broker, and it started actually with a concept of, we had 11 different LLCs that were operating similar but different. We were trying to reduce risk to the whole. And it really started out with the idea of, hey, if we merged them all together, what would we look like for health insurances and things like that? And then at the end of it, it turned into, we realized there was some value to what we had. So it led to the ultimate sell. But trying to take 5 founders, specifically clinicians at that, through a transaction was the broker's probably hardest job ever. And it was very different than the second exit that I mentioned, where we had already professionalized. Again, if you asked me as a founder pre-2016 what EBITDA was, I didn't even know the language. I didn't know what they were talking about. I knew what profit was. I knew if it was a good year, I could buy a different car. If it was a bad year, I had to sell it. But, creating I think to your point of planning early, everything you do when you start any company should be with the idea, even if you never sell it, if you're not building it to sell it, you're failing. And the reason I say that is because you definitely should professionalize up front. And as easy it is to think of, hey, let me run my toilet paper through the company because it's tax deferred to me personally, it really just creates a mess for another day. And, I'll kind of pause there, and I'm sure Lanford has some thoughts as well.
Yeah. So, I would love to say that we did have that in mind from the start. And while it was certainly a thought and a consideration, and of course, early investors, everyone asks what might be a potential path to exit. So, that was something we had thought about. The truth is, we were so, bootstrapped, and we did raise capital Of course, we were lucky enough to receive a couple tranches from SC Launch, and we put that money to good use, I think. Thank you for that. But, we didn't raise a ton of money overall, I think, relative to, the game overall. Software is very expensive, and it costs a lot of money up front. And so you have to really front load that. So I do feel like in a lot of ways we were a sort of quasi bootstrap company. And the reason that's relevant to the question is when you're, trying to survive, of course, all the money goes into things that will produce revenue or build product. And those things frequently are the same as the steps you would take to become, to get prepared for some kind of diligence, but quite frankly, they're not also. And so I can talk about that. I mean, if it came down to putting in a lot of analytics and tracking software so we could look at the entire life cycle of acquisition of a customer, following through to purchase and then retention and all that stuff, those things take a lot of time to implement and put in. And so while we knew that was important and certainly would be important in the future, if we were to start a diligence process for acquisition, we didn't want to spend the time and money to implement that, 7-8 years ago, because that money could have gone into actually building product that was going to make money. So, I mean, certainly, we knew revenue, we knew the number of users and customers at a high level, we had all those metrics. But once we really started, the diligence process, the questions were a lot more specific. And by that time, we had implemented things. I mean, we could get, very specific. I could say, look, I know that Steve saw an ad for HuntStand on Facebook and he skipped it. And then he clicked it 3 weeks ago and downloaded the app. And then a month ago, he actually started using it, and then he upgraded, and et cetera, et cetera. We could follow that whole path and create a really, compelling funnel for purchase, which ultimately was a very important part of our, our strategy to sell, right? Because we basically showed if you spend $1 in advertising, you get $1.15 back in a couple of weeks. And that sounds pretty good, of course. But that requires an enormous amount of data. We did not have that at the beginning, but then gradually towards the end, as we became more, professional and well capitalized, that's when we started to implement those type of things.
Do you feel, and I'll throw us back at Lanford because you just kind of hit on some of this. Do you feel, looking back, that there were pretty clearly defined milestones and or revenue targets for you to hit in order to really attract attention for an exit?
Yeah, for sure. So of course, I mean, there were lots of internal targets. It was first, let's have, positive month, and then a positive quarter, and then a positive year, and then you look to kind of, project that out. But as far as really trying to market the company, at least to the types of potential buyers that we were, and we probably could have, marketed and sold the company years and years before if we'd wanted to. But the magic number, at least when it comes to ARR, which is auto renewing revenue, which is kind of the holy grail of revenue for software companies. It demands the highest valuation, et cetera, is you want to be around a $10 million, figure in revenue. Or if you're not there, you need to have a path that shows that you're getting there within the next 12 months in all likelihood. I mean, there's a little bit of give and take. Of course, if your growth rate's higher, your revenue can be lower, right? Of course, but that thing does balance out, that equation does. But for the most part, if you're growing at a healthy clip, they would like to see that you're approaching that figure before you really start to get taken seriously. Because as you guys probably know, a lot of LPs or the limited partners of these groups, have written in their agreements that they can't purchase a company if it has less than $10 million in revenue or is not rapidly approaching it. So that's kind of the magic number where you go from kind of being maybe second tier is not the right word, but one that's a little more of a boutique investment to becoming a much more major investment for a lot of groups.
I think that your point is extremely well taken, in that it's regardless of your product or your company, whatever company X is, it's important to know who the buyer is. So for software, you have ARR, SaaS revenue, all those types of holy grail of revenues. Whereas then in our business, it was just patient-driven visit revenue, which led to a multiple of EBITDA or profits. And so, on our end, it depended really on who we were trying to attract to purchase. If we were trying to be the platform, we needed to be at least 5 to 6 million of profits. If we were trying to be a strategic, we could be less, or we could be a lot more. It just depends on who will ultimately buy us down the road. And of course, It's changed a little bit as money has gotten more expensive to obtain with interest rates. However, to become attractive, you have to be north, at least in the people and processes businesses, north of 2 to 3 million of profits. And then to become strategic, you could be anywhere from 5 million to 30 million. I mean, the sky's the limit because there are people out there that can write very big checks. Getting a little harder in today's market compared to a couple of years ago, but it's important to know who the potential, and I think that's the failure of everybody who gets in this, because most people found a company because they're passionate about what they do. They're not thinking about the sale. They're thinking they're going to retire and be here forever. And to know who your potential buyer will be, that will help steer every business decision you make going down the road as to how to market yourself to that type of, or that buyer specifically. And I think that's important. And it's a great point you brought up.
So I'm a young entrepreneur, just formed a company, and I come to you guys and I'm asking for help. And you say, hey, Matt, what's your exit strategy? And I say, you know what? I'm going to IPO this, which is an initial public offering. I'm going to go into the stock exchange. It's kind of the holy grail of the entrepreneurial world. What's your advice back?
I mean, I think you got to know your appetite for how well you're going to grow it. I mean, for me, I didn't have that appetite. I didn't have that runway either. I mean, so for me, yes, the company I sold to is now probably a $2 billion business.
Mm-hmm.
And yes, I could probably run the business of that as well, but that's not where most founders are good at. Most founders are good at building and not maintaining. And some founders are good at both and a little bit of both. And you have to have the skill set. But people ask me all the time, like, what do you want to do with the next chapter of your life? And honestly, I'm a builder. I enjoy the build. I enjoy the challenges. I enjoy, I like an investment time frame of 3 to 5 years. Let me get in, build it. Let me get it stabilized and sold, and then I can watch it grow from afar and maintain an investor. And I want to see my own equity do well for me on a second, third, and fourth bite down the road. But for me personally, and I think my advice would be, is you just got to make sure that's the appetite you really want. I mean, yeah. I don't have it, but more power to you if you do.
Yeah, that's a key consideration, because we talked about building the company to exit and knowing the company and the strategy around the company. But a lot of it also is knowing yourself and what you're good at and what you want out of the deal. So Lanford, your thoughts?
Yeah, I think Steve's point in that regard is certainly well made, and yours as well, Matt. There aren't a lot of people, I don't think, I've never done it all the way either, right? But there aren't a lot of people, I don't imagine, that can go from, the idea to the inception to, bringing a product to market, to the growth phase and scaling, and then having an IPO. Those are massively different skill sets. And quite frequently, people that are great at the first stage either aren't as good at the second one, or, to Steve's point, don't want to be. Right? It's a very, very different skill set. Hell, even, I at our company, and we were never a very large company. We were 24 people at the biggest. But, towards the end, and I was totally happy doing it, but you do shift into becoming much more of just a manager. You just have lots of meetings every day and lots of phone calls and looking at spreadsheets and looking at financials. And those things are all very important, and of course must be done, and must be done well to have a successful company. But it frequently isn't the kind of euphoric, breakneck, let's build this thing, let's go from whiteboard to getting a product on the market and raising money, that you experience in the first couple of years of starting a company. But to answer your question directly, if a young entrepreneur, came to me and said they wanted to have an IPO, and if it was just at a concept stage, I would, probably very bluntly say that's extremely ambitious. Let's kind of walk a little bit before we talk about, running in a marathon. It's a very, very rare thing. It's getting rarer these days, to have an IPO. A lot of companies are choosing not to do that. It was certainly a very clear path forward, even 7 or 8, probably really more like 3 or 4 years ago, but it's more complicated. I mean, a lot of large companies are deciding that's maybe not their path for various reasons we could go into, but still, that before you can even be considered for an IPO or really seriously discuss it, you need to have revenue, probably in the multiple tens of millions at a minimum. You can get away with a little less than that, perhaps, if your growth is just crazy. But typically, you've got to be a pretty major player in a particular industry or niche before that's even a concept that you should entertain.
Thank you. So for your companies, I'll throw this at Steve first. What point, you mentioned it before, at what point did you kind of know you were ready for exit? I mean, we've talked about trigger points, but you could go beyond that. You could keep going if you wanted to.
Yeah, we definitely could have. So I'll break it into two buckets. So the first exit I didn't know, just to be honest. I actually, here I was I was 39 for the first exit, just turning 40, and I really didn't know. I felt like the people were great. I think that and I still have a lot of respect for the investors that we had at the time. It was just a couple pieces that were failures. I think for me personally, and I think this is something every entrepreneur has to think about, is a lot of people build companies because they want titles. And now they all want money. They all want to build something great. They're all passionate about things, but they want titles. And sometimes the CEO role is not what they think the founder role is. And I think that's a challenge. I think so. The first time I didn't know if I was ready or not. And frankly, it is like putting on a new pair of leather shoes and having to walk in them to get them broken in. The second time I knew the day we started that I was ready. And it was built with the purpose to sell. And it wasn't because I didn't think that we had it in us. And it was more that I and the management team that is there, we enjoy what we do. We love what we do. We're passionate about saving all the employees that we bought when we bought the asset back and all the things we did. But once we created the baby and rebuilt the foundation of the house to sell it, we really built it to sell. So we knew day one going into the reboot of the company that it was built to sell. And every decision that we made was along that. And frankly, it was because I was ready to move on to something else or take a break. And so, 22 years in that space, I got to learn a lot. It's a huge chapter in my book that I'll write eventually, my wife says, but the next 22 will be something different. So we'll see.
For us, it dealt with kind of the clarity of the path forward, I think, to be honest. And while we certainly had a path forward, and of course, it was one that I shared and articulated during our investment banking process, that was largely, part of our value proposition. It was becoming increasingly difficult to see that being viable for us as a standalone entity. So either we needed to grow a lot, and we could have funded a lot of that internally, but probably also raise a lot more money or partner with some larger group that had distribution channels and products that could sort of complement our offering, or we needed to sell. And so I'll give you some examples of that. So we had been growing, very quickly over the last several years. We were between 60 to 90% growth in revenue over the last couple years, and and that was very compelling. And so all of a sudden we did have a lot more cash. We were growing the team and we were investing much more in marketing. But I was starting to feel, and I'm saying I because I think that's important in this context, I was probably the only person in our little company that really saw all the individual pieces, and they all kind of came up to my desk. And I knew what we were having to do to maintain that level of growth. And I do think we could have continued it with those possibilities that I mentioned before, whether it was raising money, strategic, or entering some different vertical that was closely associated. But it became clear that the status quo, while it was working very well then, probably would not have been able to have sustained that level of growth for another couple of years. And so then it became kind of just a simple thought process of, do we want to entertain some much larger merger or a very large cash infusion and sell a bunch of equity? Or maybe is it just cleaner for us to market the company and say, look, we brought it to this point. We believe we can carry the ball down the field for another couple of years and still look very strong doing it. But past that point, it becomes a lot more complicated for us to maintain this level of growth. And so that, I think, for me and our investors was kind of that catalyst where it's at, where we decided that we either had to make major changes that would put us into areas that we didn't necessarily have a lot of expertise with or in, or we needed to sell. And so we decided to sell.
Let's get into the process a little bit here. Once you knew, and once you kind of hit that trigger point you were targeting, what was your first move for moving towards that exit? What's kind of the first initiating step for each of you?
Yeah, so from my end, it was about getting the partner. So the initial step back 2016 was getting the partners on the same page. We had messy LLCs with multiple people, 30 different. Yeah, there was 5 core partners, but there was 30 different equity holders that were just pieces of different companies. So first was getting everybody on board with what we really think the valuations can yield, and what each of our we were combining 13 LLCs, what those each individual company was valued at as a percentage of the pie when it goes. So herding cats was the hardest thing at first. The second thing was choosing the broker, which, once we chose the broker, it's kind of like going to the doctor and having a diagnosis you got to work through. You have to get in the boat with them, row with them all at the same speed, or else you're going in circles. And, we picked a broker that we felt like could represent us well. They understood the business, and then they helped us basically relearn our business to speak the language and to sound more intelligent in front of investors. And since the market that I'm in was fairly hot, they were approached very quickly by several parties once they knew our revenue targets and where we were. Then it was a matter of, is it a cultural fit? But the first step was, getting yourself on board. And then the second was getting the right broker on board. And then from there, usually they can walk you through the rest.
I would say ours was relatively similar. Of course, I socialized the concept with our investors and with some members on the team. I didn't want to share it with the entire team until we knew that it was going to actually happen. But the investors liked it, and they were certainly open to it. And I had shared with them some of the general ranges that we had heard from that initial conversation with those investment bankers, and those they thought sounded good. And then, of course, the second step was really, working with the investment bankers. There was a lot of data that, that changed hands, and of course there would have to be, but not just, during diligence. The bankers, at least for us, created what they called a SIP, which is a confidential investment prospectus, a little 50-page book that has all the nice charts and everything that, hopefully mostly are going up from right to left and, look really, really good. And they paint a very nice picture of the company. And of course, all the details on the market and the growth potential, et cetera. And that was sent out to about 150 different groups around the country, whether these were strategics or these were, private, players or equity investors, pretty much you name it if they thought that they might bite at it. And then I can talk more about that process later. But that was kind of the initial sort of hook, was first saying, hey, look, there's a possibility here. And frankly, when I started the process, it was very much, and I believed this wholeheartedly at the time, it was not that we would sell. It was that, look, guys, we've been doing this for about 11, 12 years now. We've built something that we think has some value. I don't know that we're going to sell. I don't know that we'll get the amount of money we would like for the company, but I think that it makes sense at this juncture for us to see what we could get. Now, whether or not we choose to take an offer is another thing entirely. But what I didn't fully appreciate at the time, and if I were to do this again, would certainly understand, I think better now, is that once you invest that much time and effort in the process, and even if people say they aren't seeing dollar signs, everybody does, including me, it gets real hard to take yourself off that path once you've really started down it. It's very, very hard to do, which is not to say that I'm not pleased with what we got. I am pleased with it, but it would have been hard for me to have pulled that back from our investors and our team. I would have burned a little social capital, I guess I put it that way, if I changed my mind.
Well, and you touched upon my next question, because you've determined that you're going to go forward. You've started the conversations internally. I'm assuming, it sounds like, Steve, you were an LLC, so you probably did not have a board involved, or you may have had a board involved. You at least had advisors or some earlier stage investors involved. Lanford, I'm assuming you had a board involved, which was kind of captaining this process
somewhat. We had an informal board, but I was kind of the board in our structure that we had. Okay. So that just made things a lot easier. Yeah.
As someone who's been on a board that was exiting a company, I can say we were extremely involved in the process, both in the decision making and in the execution. That's for some of the larger companies, that's pretty typical. You're getting alignment, and you've engaged an investment banker. The investment banker is out shopping the deal and is educating you guys as to how to pitch and prep the deal for the potential acquirers. Probably started some conversations, done some pitches. You got some companies coming back at you and starting to talk with you. To your point, Lanford, you now have a whole bunch of players involved. How did you set your first? How did you establish your kind of your zone for your price? Because you've got a lot of different entities at the table now in the conversation.
So our investment bankers had help with that. These guys didn't deal exclusively in this general field, but they have helped a lot of companies, that have a similar model. Not in the same, sphere necessarily, clearly, right? Mm-hmm. The same vertical, but companies that are, that have a SaaS model that have a lot of ARR, And so they had a very good feel for what, the going rate was for a company like that had, solid retention, which we did, and had a pretty, nice growth rate, which we also had. And so I use those numbers to kind of give a range to our, to our investors and our team, saying, look, we don't know where it's going to land, but it could be, probably somewhere in this range.
Yeah. And on our end, you're right. We didn't have a board. We were founders running the business, and we had no early investors. We did all the investing ourselves. And then essentially we're a cash cow, if you will, as far as how we, the products and services that we ran. So for us, it was fairly early into the, at least the market that we were in is fairly early. And so that we weren't 100% sure where we would come back. So, of course, our broker sent out the SIMs, sent out the feelers, obviously helped us polish up anything that we needed to, which, there's always a bit of polishing, and every SIM looks the same when you get enough people involved. That's why it's hard to make them stand out. But we really didn't fully know. We knew a range, but we didn't fully know like how tight that range was until we got the first couple real offers back. We had a couple high, but highly risky offers. We had a couple low, but low ball, just let me put this out there. And then we had kind of the mean. And then, so that was early into the cycle, but then for the second exit, it was very different. So our industry, or my industry, is very, it's well spoken of. I mean, I speak on this at the very specific clinical trial conferences for founders all the time. So it's almost like a choose your own adventure book now for if you sell. Hey, if you're 1 million of EBITDA, you're 4 times EBITDA is a going rate. If you're 5 million, now you're pushing 7, 8 times. If you're north of 10, the sky's the limit. You can get 12, 13. But even COVID changed some of those valuations, because in the healthcare industry, there was a lot of significant tailwinds. But in general, everybody is, at least if they're invested in the space, everybody is a more intelligent seller now than they used to be. And pre-2016 in my space, only a few people had done it. So we sent out the feelers. We sat patiently waiting to hear. We knew, the broker had individual calls that say, hey, the number has to start with a 5 or a 6 or a 7 or a 10, whatever. But it was still very much like, let's see that first offer come in, and then that'll set the tone.
Yeah. Were there specific terms or specific things you were looking for as you were doing this, going through this process of interacting with these potential acquirers, or were there anything that were kind of deal killers that you looked at and said, yeah, I'm not going to do that?
Yeah, I can speak to that.
Yeah, go ahead. No, go ahead. You go ahead, and then I'll jump in.
For us, I was adamant always that there not be really any sort of earnout. And that frequently came up, but I immediately, that came up in conversation. It wasn't even how I entertained that. It was, no, there's no earnout, not doing earnout, period. That's not going to happen. And of course, for the folks that are listening, an earnout is when you negotiate a number, and let's say it's $10 million, but they might say, look, we'll give you $5 million cash at closing, and then another $5 million that's left, and you can get half of that once you reach this benchmark, and another half of that's going to be released once you reach this benchmark. And that sounds good, and in some cases it is good, and in some cases you have to take it. But my perspective, and I think a relatively widely held one, is, look, why would I promise you that my brand and the company can achieve certain benchmarks when I then give up all of my control to actually achieve those benchmarks? Because it's up to them now at that point to give you the money, to spend on marketing or have discussions about where to place the assets you have at your disposal. And so it's putting a ton of pressure on you to perform, but taking away your tools to actually perform and meet those benchmarks. And so that for me was a hard no. Now, outside of that, we certainly preferred a cash deal with a small amount of rollover into the deal if possible, which is what we ended up doing. But yeah. But that was kind of my big sort of negative line in the sand.
No, I actually 100% agree with that. So for us, we didn't like the idea of earnouts, because and the earnouts we were presented with from several parties was based on profits. Well, if we're no longer we may have a lot more control over the top line of the funnel. On revenue side, we really, once they hire their own CFO, we don't have control of the profit margins. And frankly, if you cut the company's expenses, sometimes that stifles the growth. And so we were adamant that we didn't want earnouts as well. the first time we did the deal, we knew nothing, and our broker did an okay job, but we were waterboarded with information, so we didn't really absorb it well, but about the different classes of shares. And so if you look at a waterfall or how money's paid out when your investment exits for the second time, we would have ultimately been diluted so much down to where, even though we rolled over a very significant amount of shares, of 40% of our shares, the way we would have been paid out in that deal, had it been average to, had it been horrible to average, our 40% would have been worth a lot less if the equity holders or the private equity group would have had the same 40% dollar value of shares. We would have been paid after they were paid. So when we sold the second time, the hard things were, we want the same valuation you got. So we're buying in at the same valuation your private equity guys bought in. We're going to be held to the same accountability. And we only rolled in 20% the second time. And other than that, it was just about, the earnouts and how much we rolled in. I think everything else, obviously there was some give and take. If people don't think that there's give and take in this process, you got to learn to win the war and not the battles. Mm-hmm. And sometimes you throw things out to be lost. My non-compete, I was negotiating for a year. I would have given them 2, but we landed on a year and 4 months. So, I was giving them things to chew on, so they didn't focus on the things I really cared about.
And just to be clear, you mentioned non-compete. For each of you, as that exit took place, did you have terms in the negotiation that either locked you into a non-compete or locked you into working for the company for an extended period afterwards, or other things that encumbered you in some way, shape, or form?
Yeah, I actually had 3 non-competes in my deal. They didn't lock me into working. In fact, I told them, if you don't need me, don't bring me. And they actually brought me on, and they were happy to pay me a great salary. And frankly, I did far less than I ever had before. And I'm not talking about the private equity round. That was a different story. I worked harder than I ever had before with them. But selling to a strategic, I had a great salary to literally work a lot less than I had, but I didn't have a purpose. So I had 3 different non-competes. The first was a certain time point and a certain geography. The second was overall time from the sale. And then the third is as long as I'm an equity holder. And people hide non-competes in various places. So you need to make sure whether it's a joinder type of agreement or whether it's a equity agreement or something like that, is make sure the lawyers do a really good job of explaining where each of those exists. So yes, I have 3 that locked me.
Well, having been through this process, what's the things you did right? What's the things you did wrong? And what kind of advice would you offer to someone who's either getting ready to do this or starting to plan for it?
So my only first advice would be I think the single hardest thing to do as a founder is to build a house and then sell it and then live in it as the new owner comes in and paints it a different color, maybe a beautiful color, but it is a very hard thing to watch your baby change. The second thing is it's very hard to watch employees that were with you for 20 years that suddenly exit because they're nervous. But you have to respect that they have to protect their families as well. So there's a certain attrition that's going to come with it. And it doesn't mean there's no love lost. It just means that people have to do what they've got to do. And it's at this point, it's just business. I think what we did right and what we did wrong, I think we just chose the wrong partner in the very first time. Again, whether it was a Phoenix Rising case and we ended up having a phenomenal exit out of it twice is insignificant. I'd really hoped that the first exit was going to be extremely successful and it would have made those people a lot of money. So I think choosing the right partner up front, it matters, and realize that everybody has the game. I mean, when those partners came in, they came in with a pomp and circumstance to tell us why they were the right partners for us. And we believed it. And realistically, they probably were. There were just several things that went wrong for it to happen. So I think choosing the right partner, knowing what your hard limits on are, what you're going to accept, and then knowing yourself to say, my role is going to be this post-transaction, and I either do or don't want to do that role. Because again, going from the single decision maker that you could write a check for, if you want to go buy an RV and say it's a company vehicle, you can do it yourself, to now you have now you have a boss. That's the hardest step, I think, to take.
I would say those are all good points, Steve. I guess to kind of add to that, it is extremely important, I think, to understand, the metrics that drive your company, of course, and this is to a point we made earlier, and then to start to gather in a very sort of meaningful third-party way data that validates all those metrics, so you can really explain that, and not just explain it, but you can say, look, it's not just a spreadsheet of data that I have created. Like, here is a third-party group. It might be an SDK, a software development kit, that we've embedded into our app, into our software, this feeding data to this third party. And then you can go in and you can validate all that stuff. And so, again, we had been tracking a lot of metrics for years, kind of internally, but it became very clear that in order to, appeal to the type of sophisticated buyer and investor that we were trying to reach, that we really needed to have that data tightened up, and we needed to have it in third parties that we didn't have access to, right? So you can't go in and alter it to make it look better, right? It is what it is. And not just that, but it has to go back, for years usually. No one really cares if you've got a month worth of data of this third party. That's great. And maybe that looks good, but they want to establish a pattern and a growth curve. And that means you can't just implement this stuff a month before you try to market your company. These are things that must have been being done for at least 12 months, and hopefully, much more like, 24 to 36 months or longer, right? And so those things were extremely important. I think something that a lot of people don't consider, at least when they're first starting the process. Now, that's not to say that you can't work around those type of concerns. I mean, companies ask you for data, or as part of the diligence process, you get asked for data. If you don't have it, of course, you're honest. You say, we don't have that. Here's what we think, and here's why we think it. But if you don't have it, you don't make it up. But, you also don't want to give them an empty folder back in response to a diligence request, right? So, I mean, you can only play that card so many times before somebody just throws their hands up and say, so what are we buying? You just, you have a name and some users. I mean, right. So you do need to create the kind of nets to gather information. And again, I'm coming at this very much from a software tech perspective, because that's my experience. But in that type of company, it's extremely important. And for us, even, it was further complicated by the fact that our app was incredibly seasonal. So I mentioned our most popular app was a hunting and land management app. And so what that meant is that for about 6 months of the year, our users were increasing. And for about 6 months of the year, they were decreasing, right? Like as we built up to hunting season and then went away from that. Now, so we had to always look at things not just in a sequential manner, but this month, this year versus same month last year. And that also meant that if we were trying new things from a marketing perspective, it was hard to see if they were working if we hadn't done them for a year, because, our users would be going up because they were always going up that time of year, or they would be going down because they were always going down that time of year, right? So it was an added layer of complexity that made it all that much more important that we had the right type of mechanisms to gather the data in the way that, these larger investors wanted to see. Outside of that, it just comes down to getting comfortable with the process, to finding advisors that you like and that you trust. And I say like, and I think that's important because throughout this process, and I'm sure that Steve, probably have a few of these moments, either you have an investment banker or an attorney or someone that maybe tells you some things in a way you don't particularly want to hear them at a time you don't want to hear them. And so it's important to have a good relationship with them, because you might have a certain set of expectations. So they might have to come to you and say, look, that's just not going to happen, and here's why. And you need to be prepared to listen, or to have them help you with other team members who maybe have stakes in the company, who need to have a little bit of coaxing to kind of come along, that maybe have unrealistic expectations. A lot of the investment banking process, at least in my opinion, and this is the way that I chose to play it anyway, and not that it was disingenuous, this is how I would have played it no matter what, but is that you need to segment into certain roles, I guess, right? And so my role, as I saw it, and this is the one the investment bankers would have counseled me to have, was, as the friendly, guy that's running the company. I'm here to answer your questions, and let's move forward, and let's talk about how we can make it work. And if things came up on the calls that were really dicey, I may comment on them a little bit and dig in a little and say, I don't know about that. We can talk about that. But then first call would be to the investment bankers or the lawyers saying, you guys play bad guy now, because I'm going to have to work with these guys later. You guys be the bad guy on this call. And they're very good at that. And so I think a lot of it is defining the roles and finding the right types of expertise and personality so that you can complement each other to work towards that final purpose and goal, which of course is the sale of the company.
Perfect. Well, I want to congratulate both of you, because you've done something that successfully done something that every entrepreneur aspires towards, but many do not make it. And I want to congratulate you for that. And I do want to thank you for your time. And I really appreciate you guys taking the time to not only participate in the webinar, but I know both of you do a lot of coaching. I see you in the ecosystem and spending time with the environment, and I want to thank you for that as well. And I appreciate you spending the time with me here today.
Yeah,
Thanks.
Glad to have you, and thank you very much.